It's time now for Smart Charts, where we look at timely topics through the charts with some of the street stop technicians. I'm Abigail Doolittle, and I'm joined by Frank Cappelleri, senior equity trader and market strategist, technical strategist over at Instinet. Frank, thanks so much for joining us on this exciting Fed day. And stock investors, they seem to like, and bond investors, in fact, seem to like the Fed's message. Let's take a look at your S&P 500 chart and see whether you think, I believe you do think, they'll continue to like it.
That's right. Thanks, Abigail. Well, I'm bullish on the S&P 500. One of the main reasons is that you continue to see bearish patterns fail, right? And we see these in bear traps, we call them. Every time there was a pause, there was a mini top formation, downside break, which didn't hold, all the way up. And we see this again over the last few weeks here, May into June. Big downside break. The 2800 obviously didn't work. Slingshot up higher, and now we're testing the highs again. Now, the potential, I guess, negative is that this was a bullish trap, of course. But I think because of the volatility we saw on both sides of the tape here, it's set up better to test these highs and probably have a higher probability of actually going higher.
So this is pretty similar to a chart that we just looked at around 4 o'clock and another chart that suggests we could see the S&P 500 go above 3,000. What's your exact target? And can you talk to us about what that pattern is?
Well, it's difficult to see here, but this is a bullish formation. This would give us a targeted move of about 3,050, if it holds, of course.
Okay, so stock investors have something to be excited about, but maybe not for bond investors. Let's now take a look, please, at your 10-year yield chart. And I love this chart. I happen to think that it's pretty solid.
Right, so 10-year yield, I'm bullish on the yields actually rising. Now, it's hard to see here, but this is an 8-month move of down 35%. And to get an idea of what this means, we have to keep it in the proper context and look at the last 10 years. It's only 5 other times did we see an 8-month move of the 10-year yield drop more than 35% here. And each time, we saw ensuing bounces in the yield. Now, the thing to keep in mind here is that all these bounces were lower highs, and the bear confines are a much larger downtrend. So there's not a call of a major inflection point, just knowing that the severity of this move is probably a little overdone and due for a mean reverting move.
Yeah, so it looks like some of the news that we received today and maybe in July could be priced in. So do you think that if the 10-year yield holds that level of support, let's call it 2%, that we're going to see a bounce back to, let's call it 2.5%, or where do you think we go?
I think 235 is a key area.
Okay.
It was a former breakdown point here. Actually, the 50-day moving average of the yield exists right there as well.
Okay, so we may be having a traditional stock rising, bond falling in the weeks or months ahead if these two charts work. And let's look at a chart of outperformance that you like. Healthcare providers. Scarlett's not on set right now or on the desk, but she is an ETF hound. And here you have the IHF. Talk to us about what you like here.
Right, so going back, I'm bullish on this. And the S&P and IHF were moving in unison up until February. And this is when the bifurcation really became apparent. And they got very aggressive in April, of course. This year was a 5-day move down 11%. So sometimes you have rubber band very extended, snaps back, which it did here. But the more impressive part, I think, happened in May. The IHF was basically flatlined in May, but the S&P 500 went down 7%. Clear relative strength. Now it's more of a bullish pattern trying to break out.